Welcome to the Swing Trading with Cycles channel. It's July 22nd, 2023, and we're going to cover precious metals today, but we'll also cover the broader market. We'll try to cram a lot in here. As I said in previous videos, I'm going to start posting more regularly again. I'll do that on a weekly basis for the most part, but very crunched for time. I have two little ones now. It's definitely a 1 + 1 = 3 kind of situation. So we'll try to go through this quickly. We'll get a lot of information in. We'll start by talking about the DXY. Keep in mind the FOMC meeting is next week, next Wednesday. They're going to be releasing their decision on interest rates and et cetera. That's obviously going to be market moving. And that's important. Last video, we talked about the dollar, the DXY, the US dollar index, how it was in a waterfall decline. We're in the latter stages of the 3-year cycle decline, right? And so we've had this little bounce here off of this waterfall decline. But just look at this like with your own eyeballs. You have a huge waterfall decline. So 1, 2, 3, 4, 5 days. And in the last, what is this? You call this 3 days of bottoming and then a little 3-day rally. We've covered like less than half of that decline. And so this is just setting up for a lower high. You really want to watch for this area here, right? Because like this is the last low that held, and then we had a waterfall decline below it. And so again, you have the FOMC meeting happening next week. And so that is going to be pivotal. What you would expect to happen is something, right? Like we do this, and then maybe we continue up for a few more days, and then the FOMC meeting resumes the downtrend. Again, this isn't a longer term downtrend into a long-term cycle low, so you would expect it to have bearish cycles in general. That's obviously good for gold and precious metals. Let's talk about gold specifically. Let's start there. Again, the 8-year cycle low was September 2022 back here. Or excuse me, that was the previous 8-year cycle low. This was our most recent 8-year cycle low. And you can see we've been in a nice little uptrend since. This is your monthly chart. The problem here, the fly in the ointment, and that's why it's so important to focus on the price action, be objective. The fly in the ointment is that we actually have a swing high on the board, or I should say we had a swing high on the board on the monthly chart, which is not good. So we made this high here at 2081, and then we actually fell below the low of this candle that marks this high. And so that low is 1932. That's an important number. We've since rebounded above it. This is your monthly candles again. This is July, the July candle. But that becomes your bull bear line. I hope you can see that, right? Like that's pretty clear. That's the difference of this doing something like this, right? Versus it doing something like this. That's your pivotal line in the sand for all intents and purposes as of right now. And there are other lines in the sand on smaller time frames that are actually a little bit higher if you want to be even more conservative. But ultimately, once we were able to rebound back above this line, that changed the picture here, right? Like this is setting up as another higher low, just like this was a higher low, right? Like you can see that just structurally. So that's the gold monthly chart. What about the weekly chart? So I posted this on Twitter. It looks like we had 2 17-week cycles in a row. This was a really weird one where, we didn't really go too far, essentially. This was a very right translated one where we rallied for 13 weeks. You could say this is all just one 34-week cycle, right? Which was pretty right translated. It doesn't really matter. The point is we've had this down leg on the weekly chart. And since then, we broke out with a swing low. Right? Again, simple price action. This candle marks the low. The high of that candle is 1933, and we broke out above it. Think about what I just said. The high of that candle is 1933. On the monthly chart, we talked about how there's a swing high below 1932. That is not a coincidence, right? That 1930 area is important. It's significant on multiple time frames. And so the bull case here is that we get some consolidation. Now, this was your last weekly candle. It's pretty obvious that this is going to open as an inside week next week, right? Like that's the most likely thing, right? Like it'll open somewhere like this inside the range of the previous week. And then it's where do we break out? Again, the FOMC. That's going to choose your direction. Very clear for you. And again, as I referenced, the higher time frames, or excuse me, lower time frames have other levels. 1946 essentially. That is the low from this week that just closed. Again, this is July 22nd. So that's an easy line in the sand for you, right? Once we fall below that, that increases the risk that we're going to test that 1930 area, and then that becomes your real sort of, like your real sort of decision point. But that's your first big warning sign. You really wouldn't want to make a lower low here. But again, it's FOMC week. We could have a spike below there and then a big wick. So it's really not till Wednesday or Thursday that this gets decided for all intents and purposes, and that's true across markets. Obviously, not limited to just gold. And on the daily chart, we rallied for about 15 days so far, and now we've started to cool off. We did close as a swing high. We kissed the 10-day moving average, and then we've bounced now a little bit. So this could certainly set up as your little, quote unquote half cycle, your like little half cycle low, and then a move up to make a higher high. Again, it's all about the Fed meeting, but this also gives you another level, right? Like we now have a swing high. Again, keep in mind, this is now a swing high on the daily chart, right? So a swing high is active below 1965.47. So call it 1966. Think about all those levels, right? So if we breach above 1966, essentially, that tells you that's setting up for this to become a swing high, a little higher low, just like we talked about the higher lows on the monthly chart. And so with that FOMC meeting, you wouldn't be surprised to see a spike lower. We obviously have a few days to trade before the FOMC meeting, but you get a spike lower. You could almost call that 1965 another area where crossing above that tells you, okay, we're probably going to come test this high of day 15 and potentially make a higher high, continue higher in the daily cycle, which would be my expectation. Again, you don't have to guess at it though, because the FOMC meeting will tell you. So let's look at silver and the gold to silver ratio. Let's look at silver first, and then we'll look at the gold to silver ratio, which gives us important clues. So silver, again, just zooming out big picture, this was your 8-year cycle low for gold in September. For silver, it was a major bottom as well. Unlike gold, it didn't consolidate for 2 more months. It made higher highs for the next 2 months. But then it's kind of come into this little sort of consolidation range. I mean, you can see that, right? Like these 3 months didn't make much progress. What is that? January, February, March, where it's a big range to be clear, but still not really upward movement. And then we've kind of stagnated these last 3 months, and we're trying to break out above that. That is very auspicious. And if we think about the weekly chart, it's a similar picture to gold. I'll reset this chart, where in this case it's a 15-week cycle, and silver is known for printing little 15-week cycles. I'll reset this chart again. So this was your COVID. Little weekly cycle. That was 14 weeks, right? And if you go back, this was a little 18-week cycle, more or less. So those kinds of like really short-lived cycles can kind of throw one off. That's why I really try to focus on the price action and less on, what's the timing band. The bear case though is actually very clear. Look at this red candle on the weekly. This could be setting up for this being a lower high than this, which was potentially your week 8 top. So that's something to watch for. We closed at the lows on the week, but look at how big this last weekly candle is. That means that basically you'd have to take out this whole move to really get bearish, and that's down to 22.75. Now, obviously, percentage-wise, that's a pretty hefty drop from there, and that's why, again, you want to be sort of cool, calm, and collected as you're looking at the Fed sort of week play out, because that's what's going to really tell you. Okay, so that is silver. Let's look at the gold to silver ratio. And again, we generally, to be bullish precious metals, you want to see that going lower. And the monthly chart, I tweeted about this. I mean, this is pretty damn, this is a pretty bearish looking chart as of right now. This is all just consolidation, to be fair, but it's after this downdraft. And so the presumption is this whole choppy mess is going to resolve lower, below 75. So below 75 on this ratio. And it suggests that we might even test here, which would mean a huge rally for silver, most likely, and also just good for precious metals as a whole. So that's the monthly. And if you look at the weekly chart, we had this huge downdraft here. Look at this big red candle the week before last, and then this tiny little green candle. This is most likely setting up a lower high. Again, Fed meeting should help us help to nudge this in the right direction. So that's the gold to silver ratio. On the weekly, on the monthly, showing you bearishness. And obviously we're getting a little bit of a rebound on the daily. That's why we have a green weekly candle. But look at this, just a little tiny move up on a daily chart, setting up for a lower high, most likely. So that's the precious metals complex. So far, nothing unhealthy about this rally out of the 8-year cycle low, but there are very clear levels to watch. Again, price action, like focus on the price action. Now, when thinking about the broader markets, I will say I've put in a little short on the QQQ. And I say a little short to be very clear because the prevailing trend is absolutely up. That's pretty clear. It's very clear now. It's very, like, October was, some kind of major bottom. The catch is we've already rallied 9 months, right? So this is the month 9 of the rally. And look at how vertical this thing has gone for the last 4 months, closing in on making new all-time highs. But it does look like we're probably going to have a weekly cycle decline before that, at the very least a daily cycle decline. And so a tactical short makes a lot of sense here. I mean, look at this big rally. I originally looked at something like Facebook or a Meta, and that was super expensive, the sort of implied volatility on the puts, whereas, puts for QQQ, very low implied volatility, like 11%, something like that. And so that's the monthly, but if you look at the weekly, even more ominous. Look at that. This thing has been rallying for 18 weeks. 18 weeks off of this bottom. This was a very ugly cycle, by the way, but 18-week rally. Very likely, look at that. We closed almost on the lows. You expect it's going to at least kiss the 10-day moving average. So we're talking about getting down into the 360 area. Not huge downside, and one where I'll look to take profits really quickly because, again, I think this is just setting up a higher low that's going to ultimately make all-time highs within the next few months and, probably end up beyond that. Again, a lot of people still bearish on the market. That actually gives it fuel to go higher. And if we look at the S&P 500, a very similar situation, except look at the weekly chart. The weekly candle did not close red. It actually closed green, but it's the same situation in terms of it having rallied for 18 weeks. Now, what that means is just that 18 weeks is a long time for a weekly cycle rally, right? You can see this weekly cycle petered out on week 16, right? And this is still relatively bearish phase. If you go back to the bullish phase, to be fair, you had this cycle that was 24 weeks. This was 22. This was 26. So this thing could absolutely continue to run several more weeks. But at some point, you're going to get this multi-week pullback that always resets the market. And the Qs certainly look like they're stepping into it, which again that's also an important point. That's why I didn't take out a small short on SPY, but QQQ instead, because that's showing more weakness, QQQ that is. And if you just look at the indices compared to each other, this is a monthly chart. You've got SPY here, upper left, QQQ right next to it. And then you have the Russell on the bottom and DIA next to it, which is the Dow. And you can see the monthly charts. Remember I talked about how we went vertical? The Qs have gone more vertical than the other indices. So it makes sense that it would need some time to cool. It's a little bit of a cool off in terms of structure. But it also gives you the sense, look at the Dow here, look at the Russell. These are going to play catch up at some point, just like not even in terms of price as much as structure. I mean, look at this. You had this long consolidation. I'll zoom in. This is the Russell. You've had this long consolidation. At some point, this thing breaks out above the top of this. What is that? The $200 range. The all-time high is 244, so that's not a huge percentage, but it'll probably get past that. And if you go to the Dow, very similar situation. Again, not huge percentage gains, a lot less than the IWM in terms of getting back to all-time highs, But same kind of situation. Look at that. 1 month, 2 months, 3 months, 4 months, 5 months, 6 months, 7 months, 8 months of going absolutely nowhere while the Qs have been going vertical. At some point, all of this pent up energy is going to explode. It looks like it might be starting now. And so, as we watch this weekly cycle, as we watch this daily cycle decline play out, we'll see if it becomes a weekly cycle decline for the across the indices. I'm going to be cautious. Again, I do have that small put position, but looking to potentially get in on something like the Dow and IWM as a catch up trade, just structurally. Look at this thing, just set to explode. And what is the consolidation for IWM? What is that? 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 months, right? Wow. So we'll see. Definitely presents itself as an interesting catch up trade. So that's the update on gold and precious metals complex and also the broader markets. We bottomed back in October, but we are about to undergo a pullback. That's going to most likely resolve as a buying opportunity. You look at the weekly charts of everything, just again, not to belabor the point, but look at that. The Qs are actually the only of the four majors. The Qs are the only ones that is the only index that actually closed red on the week. And look at that. It's actually a pretty healthy chart for the Dow. Again, I hate to go too long when a larger index is selling off like this. So even with this, it could get kind of dragged down, but just kind of long term, this base that it's built here is going to set off an explosion. So that's your update. Thanks for watching.